Good afternoon, everyone, and welcome to the March Accounts Receivable Core Committee. My name is Gerald Floyd. I hope you're all having a good day and enjoying the spring weather. We normally do our introductions when we're in person, but we've kind of gotten used to doing the video meetings, and it's a little difficult to talk over everyone, but we'll certainly include all of the attendees in the minutes. And with that, we'll go ahead and get started with today's agenda. First up, swarm announcements. Just a reminder that the Q3 accounts receivable performance measure reports are due April 30th. So just keep that in mind as you close out the month of March and start working on your data for the ARPM reports for Q3. If you have any questions about your data or as you're putting it together, please feel free to reach out to me. More than happy to answer any questions you may have. Next up, we're going to have a bit of a discussion. One of the things that we have tried to do recently is use the ARPM data just a little bit different than only in the accounts receivable management report. And part of that is, as we look at that information, we want to try and identify not just that agencies have submitted their reports and including targets, but kind of how do, I guess the best way to describe it is how do like agencies compare to one another. And so I put in the agenda, it's a comparison of peer groups, but that's basically just one way of kind of capturing what we're trying to do, which is being able to sort of slice and dice the information in a couple of different ways. These are a couple of the current ways that we're looking at it. One is the ARPM required. As I start showing you some of the information that I'll explain why that's important. But we started with the agency budget designations as an agency group, and then kind of translated that along with information from agency websites into peer groups, or one way to think of it as like functions. And so with that, what we have done is been able to kind of take data going back to 2020 for the quarterly ARPM information, and now group it via pivot tables and so forth. And I've pasted the information into this just to kind of show you how we're using that information in a way to look for where an agency might be a little bit different than others in their similar peer group. And just as a point of clarification, this is our first attempt at creating these peer groups. They may change over time as we learn a little bit more. I certainly can, have made some mistakes about where an agency should fit. And even within those peer groups, not everybody is going to be or would be expected to have similar results. But this is just a way to kind of identify where an agency may be different than their peer groups and get a better understanding of why that is occurring the way that it is, and work with that agency to clarify that the information is being reported in the same fashion, that their understanding of the terminologies and so forth are correct as far as the templates go. So if you happen to see your agency highlighted here, don't panic. It's not a bad thing. It's just we want to begin having some conversations with agencies as we identify where those differences occur. So I don't want to, take a bunch of time and kind of discuss, why, because again, the way that we're slicing and dicing this information, we may look at it a little bit differently after this first round and create additional levels of peer groups, different designations to try and put truly like agencies in the same groupings for this comparison purposes. So kind of what you're seeing here with these highlights is just basically where, this is the administration group. You can see the list of agencies that are designated here. One is the collections aspect. The other is the percentage of the AR that's over 90 days. This does not mean that it is a liquidated account. We all know that from the ARPMs, but it's a comparison to say, when we're looking at how much is being collected and how much of that is L&D collections, as a comparison to the percentage of accounts that are becoming 90 days past due. What you're seeing here is, for example, this one is 74%. That same agency, their total value of the accounts 90 days past due, excuse me, the percentage is about 21%. So it's kind of like one's high, one's low. Same thing with this next one. So we're just kind of looking at where it's different. It's not the same relational balance, if you will, of L&D collections. Excuse me. And so this is kind of, again, this is just our first take at looking at this. And I just wanted to bring it up so that if you start getting some emails from me, asking some questions or a request to meet and discuss kind of this information that we're seeing here, this is where it's coming from. We just want to make sure that we're doing our best role in evaluating the information and making sure that what we're including in the management report at the end of the year, that we ask the correct questions throughout the year to make sure that that information and percentages are being reported correctly for the management report, as well as trying to help agencies look at that data in a way, how can it help the agency make improvements with their collections, reducing the L&D balances. And so, excuse me, something in my throat. So here again, we're looking at these as peer groups. Kind of when we first were looking at it, we designated administration, advocacy. It's really kind of agencies that are not as much regulatory, but more there to assist a certain demographic of the population. Education, very small group there. This does not include universities. Universities are not subject to ARPM reporting, so that's not included under education. Natural resources, that was a budget designation, so very appropriate to carry that forward. Policy oversight, agencies that have a role in establishing policy. Public safety, regulatory and licensing versus a regulatory oversight. Kind of broke those two up because, from what we were seeing, not every agency is truly a licensing. And again, I may have made some mistakes. If If you think that your designation is categorized incorrectly, please feel free to send me an email, and we want to try and continue to evolve this effort as we look at these peer groups so that going forward we can have a common designation of how we would look at those groups and which agencies are an anomaly compared to the rest of the group. So I will admit, I'm entirely possible I could have you in a wrong classification first time through. So just wanted to share with you, this is kind of a way that we're looking at this information a little bit differently. We're still looking at every quarter report to make sure that, targets are being established, that they're reasonable. We're trying to get agencies where the target versus actual is the best way to describe it is within a standard deviation. It doesn't have to be perfect. It can be over or under, but you're doing a good job of establishing those targets in a way that you're at least close to what ends up happening, and certainly understanding that there's going to be circumstances that you make assumptions and those assumptions don't come to fruition in reality, and that's okay. How do you learn from that, and when you're establishing the next set of targets going forward, so that you don't continue to use assumptions that are not valid? So we'll continue that effort as we look at each quarter's ARPM data, but this is kind of just one way we're looking at this information and wanting to make it as reliable as we can, since we do some comparisons between it and LFO data. So I'll pause for a second just to see if anybody has any questions about kind of this new way that we're looking at the information and how we're going to use it. Anybody? Make sense? Okay. Moving on then. Let's see, legislative bills. Go to that here. Session moving along, as I'm sure some of you have been tracking different things for your agency. This is the list of bills from that I shared in January. Might have had a few more added since then. One of the things I've been hesitant to mark anything as dead in committee, even though March 17th was a deadline for committees to schedule a work session on a bill in the first chamber. Just because I've noticed sometimes I think the OLA system can take a couple days to catch up. So as soon as I think it's past that deadline, it's actually gets updated after that. So probably after the end of this week, I would consider any of these bills that, like House Bill 2444 here, it was referred to education, has not had any public hearing or work sessions. More than likely, that one is probably dead. And so any of these others that you see where there's been no scheduled activity, chances are those are probably not going to move, with the caveat that in this sheet, these that are in the gray highlight are referred to committees that are not subject to the March 17th deadline. And that applies to the rules, revenue, or any joint committee. So those could still move at a later point during the session, but nothing as of this point. So the first section that you see here is associated with changes associated to agencies. new agencies, abolishing agencies, name changes, those kind of things. So far, really the only one that has moved in this group is 2411, passed the House and is now sitting in the Senate side, dissolve the Alfalfa Seed Commission. So the next section of this is what I designated as bills that would have an impact on collection processes. And House Bill 2008, this was probably the one that I was most curious to see what would happen with it. It significantly changed garnishment exemptions. My understanding is there's been some draft amendments. I don't think they're posted on OLIS yet. But basically what this originally did was essentially quadrupled like the wage exemption. Sounds like the amendment will settle somewhere in between what is current law and that quadrupled amount. Still is a fairly substantial increase in those wage exemptions. There's other items that are included in that bill related to garnishment exemptions and executions. Not quite as much of an impact on state agencies. We don't typically go and seize jewelry and cars and so forth. And it probably happens occasionally, but it's not an agency's first desire to be in the business of getting rid of vehicles. So the wage garnishment is one that we'll definitely keep an eye on. It has a work session next week, so that's probably where they're going to introduce that amendment. And so if you're an agency that deals with garnishments, that's one to keep your eye on. House Bill 2029 has already been passed by both chambers and signed. This has to do with recordings of the county clerk now have to be in a minimum 10-point font compared to previously 8. So if you are an agency that does record documents with the county clerk, keep in mind, once this bill goes into effect, which is January 2024, that those documents do need to be in a minimum 10-point font. The rest of these, House Bill 309 has passed the Senate and is now sitting on the House side. This changes the number of weeks notice for persons in an estate publication. Senate Bill 228 has passed the Senate as well. And this has impacts the Construction Contractors Board and then when they can revoke or suspend licenses. Senate Bill 24 has also passed the Senate. This has to do with where universities and community colleges and so forth cannot refuse a transcript because of a debt owed to the institution. And we saw a work session yesterday on the bill that would allow me to accept credit card payments. Similar to that bill, 538 has had a -A amendment and has passed the Senate with that -A amendment. The bill summary was that it authorized any state agency to accept credit cards. The amendment basically removes the authorization and says that agencies that are authorized to accept credit cards may now add the credit card fee to the amount of the payment, so that the agency isn't having to to pay those fees out of their budget. So a slight change. So it's still important that Senate Bill 222 moves forward for Denami's purposes, because otherwise they didn't have the designation in their statute that authorized them to accept the payment by credit card. So funny how the wording is so precise, in that agencies are limited in their authority for something what would seem as simple as accepting a credit card as a standard method of payment. So we've also had a little bit of movement on Senate Bill 912, which authorizes the Employment Department to deduct future weekly and family medical leave insurance benefits for overpayments that were the individual's fault. They already have some language to that effect, but I think this is specifically on the family and medical leave insurance versus like the unemployment insurance. So Senate Bill 184 has a -A amendment. This modifies the employer child support reporting requirements. Basically what this does is, as an employer, you are required to submit basically what's called a new hire report to the Division of Child Support. I believe it's within 30 days of hiring that employee. What this bill does is, if you also hire an independent contractor, they're not considered an employee, but those independent contractors, because they are individuals, you treat them as an employee for purposes of this reporting to child support. Effectively, what it's doing is it's notifying child support that somebody is working for that employer, so that if there's a back child support owed, that they can issue that garnishment to that employer slash hiring entity of the independent contractor. So I know that kind of creates a unique situation for state agencies, that you kind of now have to have your procurement, your HR folks working together to, make sure that independent contractors get to the HR folks to be able to get added to this list of reports that are submitted. But that has passed the Senate and has been referred to Business and Labor on the House side. I would suspect that, given that it is a child support benefit, I do not see why this would not pass in some form. Senate Bill 981. This is kind of a technical fix that DOR submitted with the last round of changes that were made within ORS 293231. Accounts that originate in DOR no longer fall under the authority of DAS to issue an agency-specific exemption from the requirement to assign to a private collection agency. So this basically puts back into statute what was there before the last changes that were made to that particular statute. House Bill 2471, which has to do with OHSU and DAS and Department of Revenue studying how to revise a repayment method for individuals that get a scholarship for the Healthy Oregon Initiative, but have not fulfilled their requirements. It's kind of, as I said in the last ARC meeting, this is an interesting one. It very specifically kind of ties our hands, but then says, go find the best way to establish these repayment methods without giving us the tools to kind of best implement a repayment. So next, let's see, this one hasn't really moved, so we won't go into that. I will include this list and its current status in the minutes for the ARC meeting today, so you can take a look at these bills a little closer if you want. But the next deadline is April 4th. It needs to have had a work session in the first chamber. If it does not, then it is definitely dead in committee. So some of these are moving. I would suspect that at least half of them will probably be dead in committee by the time we meet again. So any questions on 2023 legislative bills? I unmute. Nobody's talking today. Okay. Boy, we're moving right along then. Next on our agenda, with the change in administration, we have a new DAS director. With the publication of our management report, the DAS director reviewing that, and kind of with the new focus of the new administration on kind of the agencies are performing and the role that DAS would have in that. I've been asked for my scope to look at how can we best show that we're helping to move and make progress on statewide collections and receivables management. And a couple of the things that we had identified, one, we have typically had about 80% of agencies eligible to receive the accounts receivable honor roll. That means we have about 20% where they missed a deadline and therefore didn't receive it. Where our goal is to work with those folks that have not received it in the last couple of years, to kind of work with them on ways that they can continue to meet the deadlines and hopefully receive that honor roll designation moving forward. The next element of what was identified for leadership was, looking at agencies that have reported unassigned non-exempt accounts in their LFO data. We know that agencies have had accounts in that category for a variety of reasons. So we're still, the focus here is not that you have zero, because if it is a legitimate reason, we don't want to, manipulate the information in that regard. But if you have accounts that were subject to assignment, didn't get assigned, we want to work with you to make sure that those assignments are occurring within the statutory timeframes moving forward. One of the areas that I know has caused a bit of confusion and has been included in that unassigned non-exempt category over the last couple of years are accounts that were identified as RWO by Department of Revenue. And so I want to share, for those of you that have used the LFO reporting worksheet before, this will look familiar to you. This is kind of my showing some examples. So I've changed the column headers, but just to kind of show you what we're looking at. In this example, you have an ending balance, 95 accounts for $750,000. Of that, 600,000 is assigned to DOR. That also has exemptions reported of 150,000. In this case, I called it state agency receivables. And so as a result, the formula for the unassigned non-exempt shows 0 accounts. Everything is either at DOR or is exempt from assignment as identified, in this case by SWARM, but by the agency. So you don't have anything that would be unassigned over 90 days with no payment. That's when you have an exemption. The next column here are accounts where you have RWO accounts at DOR, but the agency has not written them off. And in this case, this is kind of where what we've seen happen in the past is an agency would report those RWO accounts as returned to the originating agency, thus reducing the balance of accounts. Looks like I modified my thing as I went along, but in this case, 600,000, there are no exemptions. So as a result, you have 25 accounts for 150,000 that are unassigned. For purposes of this example, all of those accounts have not had a payment for more than 90 days. Notice that these accounts that are unassigned match the RWO return to originating agency. This is done because the agency did not report a write-off in section 2. Because the RWO is still at DOR, I would say my recommendation is to report it this way in columns M and N, which is not to show those 25 accounts and 150,000 as a return to the originating agency. Therefore, it will now show the balance at DOR is 750,000. Notice now you have 0 unassigned non-exempt accounts. Again, this example here is the accounts have not yet been written off by the agency. This is the recommended way to do it. This is what we've seen people doing in the past. Once the agency writes it off, now in section 2, write-off has reduced the balance down to 600,000. Now you would reflect the RWO as a return to the originating agency so that it correspondingly reduces the accounts outstanding at DOR to 600,000. You still have 0 accounts that are unassigned. So I think in the past, sort of the pre-centralization model, when accounts were canceled by DOR, the reporting has sort of taken that same approach and said, oh, it's RWO at DOR, so I need to remove it from my section 3A balance. But it was creating this unassigned value, even though the accounts were still technically at DOR. That's why the recommendation is to report it this way, until such point as you actually write it off. Now, the importance here is agencies should be regularly reviewing their monthly reports, and anything that moves into the RWO status, agencies should be reviewing those accounts against the write-off criteria, timely writing them off so that your ending balance in section 2 is appropriately reflecting what you reasonably expect to collect. Now, certainly understand that we have some circumstances where due to some system limitations and how an agency um, needs to continue to see that balance, even though they recognize that the likelihood of collecting it is nil. For licensing purposes, for example, they need to keep that on their system so that if they reapply for a license, that they don't issue a license when they had a previous debt. I know that there are some examples like that. That is why if you, even though it's in an RWO status at DOR, if you don't show it as being returned, it's now going to match, in this example, your Section 2 ending balance, and you don't have unassigned accounts. What we're trying to avoid is a confusion where this 25 accounts for $150,000 is being perceived by legislative members as an agency that is not doing what they're supposed to do under the statute. You've done it. The reporting is just kind of in this limbo where it's RWO, the agency hasn't written it off, so it's kind of getting picked up as an unassigned no payment. But this is really a cleaner designation until it is truly removed from the agency's books. I'll pause there to see if there's any questions on that. And I plan on for purposes this year, we will do probably a Teams-based training versus the previous recordings that we've done. And I will include this in that training as to kind of how these RWOs are best captured. So, Shamay, I think you had your hand up. Do you have a question?
Yeah, we've been removing that from our total. So if we want to start using this new process so we have less of that total unassigned, non-exempt, would we just have to add it back in that it was put back at DR? I mean, how do we get that balance back in if the beginning balance didn't have it?
So you showed it as a write-off in a prior year. Is that my understanding you correctly?
We didn't include recommended for write-off amounts that were at DOR in our total for what was at DOR because we considered it inactive, and so we had a high amount that ended up in that total unassigned. So if we were going to do it this new way, how do I get that balance back in?
You would basically include it with your additions, like for FY23, whatever was actually assigned, and then this amount that you need to put back in that's in that RWO status. That will, again, it will get this accounts outstanding at DOR to be more in line with the cumulative reports that you're getting from DOR, including those that are in RWO status. So do you not write them off for the kind of the similar reason that I described? You have a licensing system issue?
A lot of ours would be civil penalties, and sometimes we have liens that are active on them, or they're looking at the case once it's returned and determining whether they want to write off. But we've had so much turnover at DEQ in all of our programs. It's constantly retraining and getting people to actually take the time to write it off.
Gotcha. Well, like I said, we certainly recommend that there's a regular review of those reports and kind of instead of waiting until the end of the year and then trying to do everything all at once before year end, if you look at those reports monthly, now you're only having to do a few of them at a time. But I certainly understand a lot of agencies have had a number of turnovers in accounting positions this year. So on the one hand, I understand it. On the other hand, the policy and advice is write them off as quickly as you get the information. So.
Thank you.
Yeah. Any other questions on this?
Hi, Gerald. I have a question. I have one account that we have a payment plan with, but every year it's under the total assigned non-exempt accounts. Shouldn't there be a field that says at agency for collections or payment plan?
So let me kind of show on here an example of this. So what you're talking about is like here you've got an account, just for this example, 25 for 150,000. This is the formula. This is a
Yep.
field that you fill in that says of that amount, which accounts have not had a payment for more than 90 days. If this is 0, that is perfectly reasonable to put that in there so long as these accounts have had a payment. That basically,
Okay.
you're still within what you were supposed to do as an agency, which is if you've not had a payment for 90 days, you need to assign it. But since you are getting payments, it's not yet subject to assignment. It's
Okay.
the values that are in this row that we're worried about.
Okay. So just in the agency notes, just say it's a payment plan. Okay.
Exactly. Yep.
All right. Gotcha.
Thank you for that. Any other questions? Okay. Well, that's all that I had. I guess we went through that a little quicker than I expected. Roundtable. Does anybody have any general topics they would like to discuss, questions they'd like to ask? Todd.
Hey, good afternoon, Gerald. So I'm Todd Evans with the other agency accounts, and I just wanted to let everybody know there's a small change happening. Shouldn't affect you, but we are adding a 4th private collection firm to our mix of agencies that we assign debts to. Your debts will still be only going to 2 of them. So this Friday, hopefully, we'll be sending our first file to the new company's called Coast Professional Inc. And so we're going to start collecting data on how well the private collection firms do. And so what that data will allow us to customize how we send debts out so we can reward private collection firms for doing well at collections by giving them more debts. If we determine one of the collection firms does well at, let's say, collecting debts owed to a business or owed by a business, we could funnel more business debts to that collection agency since that's they excel in that type of debt recovery. Yes, so that's it.
Thank you, Todd. Anybody have any questions on that? It basically gives it DOR, I think, a few more options to spread accounts around and, get that competition among them to do the best on behalf of the state. Obviously, this won't affect things like if you have a new account, that debtor already exists and is already at a firm, we're still going to match those up and get the second account to the same collection firm, that type of thing. That will still work. They just got another vendor in the mix to be able to work with. So, anybody else have any items for roundtable? Questions? Discussion? Well, you all were so quiet today. We went through everything much quicker than I anticipated. So I will give you, looks like about 45 minutes of your day back. Our next meeting will be on May 16th at 2 p.m. So until then, remember April 30th, the deadline for your ARPM reports. And you all have a wonderful rest of your afternoon.
Thank you.
Great. Thank you, Gerald.
Thank you, Gerald.